Welcome back to the Journey Crypto YouTube channel. Today is a perfect example of why most people lose money in this market, not because the asset fails, but because emotions overpower context. Over the past few days, fear-driven narratives have been everywhere. Rising interest rates in Japan, broad pressure across global risk assets, and, as always, a loud chorus confidently claiming that XRP is about to collapse. Yet here we are, still holding levels that many said would never survive. That disconnect is exactly what we need to talk about. This video isn't about celebrating a green candle or pretending that short-term price action guarantees anything. It's about understanding why markets so often do the opposite of what the crowd expects, especially when sentiment becomes stretched and confidence breaks down. History shows us something uncomfortable but consistent. The most important moments in markets rarely feel good while they're happening. Right now, you're probably hearing endless technical arguments, moving averages, oversold indicators, historical comparisons. Some of that data is valid, some of it is selectively framed, and much of it is abused to sell certainty where none actually exists. So instead of asking, is XRP about to explode, the smarter question is this: what does it mean when price holds firm despite negative macro pressure? Because that's where real information lives, not in excitement, but in resilience. We've seen this pattern before. Long periods where patience is tested, where conviction erodes, where people convince themselves that walking away is the smart decision. Historically, that mindset tends to appear near inflection points, not because rallies are guaranteed, but because weak hands exit when pressure feels unbearable. The goal today isn't to predict what XRP will do next week or next month. The goal is to help you understand why narratives swing so violently, why people anchor to past moves without context, and why infrastructure and fundamentals matter far more than short-term sentiment ever will. If you want to understand why XRP continues to matter even when confidence is shaken, and why markets often move when conviction is at its lowest, stay with me. To really understand what's happening right now, we need to separate noise from signal. Most people are reacting to headlines without understanding how markets actually process stress. Rising interest rates in Japan sound dramatic, and on the surface they should pressure risk assets. That assumption isn't wrong, but it's incomplete. Markets don't move on single variables. They move on how expectations collide with positioning. Japan's tightening matters because it impacts global liquidity. For years, cheap yen funding fueled risk-taking behavior worldwide. Assets that can hold ground during tightening cycles tell you something important about what's happening beneath the surface. When price holds above key psychological levels, it signals that selling pressure is being absorbed. If the market truly believed rising rates were an immediate death sentence for XRP, we'd already see downside acceleration. That hasn't happened. What's different now compared to many past cycles is that this market is far more institutionally observed. ETFs, regulated on-ramps, and professional custody solutions have changed who participates. This doesn't make the market safer, it makes it more deliberate. Maturity frustrates retail participants because it removes the illusion of easy money. Fear doesn't peak when price is lowest, it peaks when patience is lowest. Consolidation phases exist to punish impatience. They don't reward conviction loudly, they reward it quietly. Smart money isn't trying to front-run a breakout, it's trying to avoid being wrong. Capital preservation always comes first. Until liquidity conditions, regulation, and infrastructure align, patience isn't optional, it's policy. Constrained liquidity creates compression. Compression creates asymmetry, but that asymmetry only resolves when something fundamental changes in the system. Phase 1 is infrastructure readiness. Phase 2 is pilot usage. Phase 3 is integration. Price responds late in that process. XRP exists in a category many retail investors still underestimate: financial infrastructure. Its adoption path is closely tied to legal clarity and institutional permission, particularly around companies like Ripple. That slows visible price action, but it increases long-term viability. XRP isn't designed to reward impatience. It's designed to function when systems demand efficiency, not excitement. Emotional capitulation usually happens before clarity, not after it. This phase is about discipline, understanding why nothing feels urgent, even though everything feels important. Markets punish constant action more than they punish patience. Don't let noise rush you. Use tools for context, not for direction. Let structure guide your behavior, not your emotions. This content is for educational purposes only and is not financial advice. Always do your own research. Thanks for watching my videos. Please don't forget to like and subscribe.